Welcome back to the Main Street Meets Wall Street podcast, where we continue our deep dive into the complexities of the U.S. national debt with our expert guest, James Callahan. In part one, we uncovered the staggering figures behind the national debt and its implications for both Main Street and Wall Street. In the second part, we dive further into the intricacies of debt ratings, explore the role of credit agencies, and discuss the potential impact of the financial dynamics of our economy. James brings this unique perspective, offers actionable insights to enlighten our audience. Join us as we continue this important conversation and uncover what the future might hold for our financial landscape. Let's dive into part two.
You mentioned we went off the gold standard, Bretton Woods, in the 70s. So the value of the dollar was based on the scarcity. But when we started pumping dollars into the system post-pandemic, you increased the volume of the U.S. dollar, and which saw the value decline because now there's so much of it, and hence this sort of benefited the belief that we need crypto, something that was free from central bank intervention and influence. But I think it's important that the U.S. to maintain its economic status have a strong currency. If it's the number one currency, that just it identifies that the U.S. is an economic engine and powerful. It concerns me when I see China, which was one of the biggest holders of U.S. debt. They've been, over the past 5 years, they've been reducing the amount of debt that they hold, and that reduction has been pretty significant. I think it was like 1.5 trillion down to like 700 to 800 billion. So that's a concern. And I don't know, again, I mentioned in my lifetime, the U.S. is the strongest economy. That's expected to change by over the next 10 years, with China and India emerging as economic powerhouses. So I can only think that if the U.S. gives up its top spot as the economic powerhouse, that will be hurt. I don't think it will be a good thing, and I don't know if that's selfish, me selfishly speaking, but again, I've never known a time in my life where that's happened. And so I'm assuming that probably won't be the ideal situation. So yeah, I'll just leave it at that. And again, I wish I could give you a deeper level discussion with that, but there are so many other parts and pieces that go into it. But I just think a strong economy is good. We do a lot of global trade. We have a free society. People can come in here and do business. We don't have a ton of restrictions. And I think those are good things. It's not perfect, but it's difficult to do that if you wanted to go to another country. There may be more restrictions. It may be difficult to get your money out or pull it out or repatriate it. So I would just like to see the U.S. currency remain strong, and I would like to see our economy remain strong, and to be a good global citizen and competitor.
Exactly. I mean, capitalism is the worst form of economics until you try the rest of them, right? That's not my quote, and I butcher it. But until you look at the other economic philosophies, then you'll see. Yeah, you need a strong economy in your country. James, you're giving so much great information, man. Don't worry. I still have a couple more things I want to just ask you about.
Whatever. Yeah, that's fine. You take your time.
Yeah, no worries. Yeah, it's just so you hear, because I just want to ask questions I know I'm hearing people ask. You hear politicians or the government go and they talk about GDP, and they talk about, you can see double-digit GDP growth, but they're combining the two numbers. Could you maybe expand on that a little bit more for Main Street when they speak of this? I think it was 8% nominal growth GDP last quarter, something like that. It was something really high.
I think it's hard with an economy this size. We've seen China as a great economic engine, and their GDP growth has been in the mid to high single digits. I think for the U.S. to get anything above like 2.5% would be pretty solid. Again, because we're a developed market and we're substantial, and again, the number one economic powerhouse on a global basis, it would be hard to generate that kind of growth. So I don't think that that's possible. Constructive that we can see. Look, if we see like a 3% grant, that would make me pretty happy.
Yeah, I'm sorry. I'm talking about nominal GDP versus real GDP. So that's probably where the difference is in the numbers that I'm referring to.
Yeah, nominal GDP considers or factors in inflation. I mean,
That's where they're getting the spread and saying it's like
yeah,
eight.
I don't want to see. I would hope that inflation doesn't run that high. We've seen it slow its ramp in recent quarters, and very important to get a handle on that. I would hope not, Marcus. I would think that would be problematic because then you know, when you have runaway inflation, then it has to be addressed through, monetary policy, fiscal. It just, yeah, it would be a problem because now the Fed would have to start thinking about raising rates to slow down that pace of inflation, and higher rates would slow the economy. Now that's a drag, higher cost of doing business, to purchase, et cetera. I would hope it's steady as she goes. Is 2% inflation, which is one of the Fed's mandate, appropriate? There are a lot who argue it should actually be raised. I wouldn't be opposed to that. Again, there are smarter people who discuss those things and could give you better reasons for why that should be. Uh, but it's real important to cap inflation, not to let it get out of control. And it would be a lot better for consumers and for the states. Again, we can talk about, it makes it easier to deal with debt. Overall, you want to see steady progress, consistent GDP growth, interest rates that are stable but low, to help us going forward as we look out over the next 5 to 10 years in terms of debt servicing, maybe closing those deficits and reducing deficit spending. That's what I would prefer to see.
Right.
I don't
Otherwise,
know.
go ahead.
No, I'm sorry. I don't know, Mark, how many of our politicians really have, a lot of them have legal backgrounds, very intelligent people, but I don't know how many um, have a good understanding of economics and financial statements, just concepts that I think they don't teach in school. Sometimes you have to go beyond to get exposure to them. But I would hope today, with the proliferation of the internet and the ease to access this information, that more people are getting up to speed or getting an understanding. And I'm not always convinced that our politicians have the firmest grasp on economics and the situation, what it means. Because I think if they did, the levels of spending, maybe they'd rein those in a little bit and understand that you can't spend more than what you take in. I don't think that's a terribly difficult concept to understand, but it's hard. It seems hard for them to follow that, and it's yeah. I think it needs to be addressed.
Yeah, well, I mean, like you said, since the 70s, we walked by Bretton Woods and the gold standard, we've been kicking the debt down the road for a while now. And it's interesting that you say a lot of the politicians are lawyers, because I know Jerome Powell isn't a politician, but he was a lawyer, if I remember correctly. He was an attorney, which is very interesting. He's ahead of a big part of our economy. So James, I want to kind of bring it back. You mentioned the internet, so thinking back to rating these companies back then, like a company was Oracle. I think Oracle was coming up back then. Larry Ellison and Oracle back in the days, and now they're at the top of the news when it comes to credit default swaps and the AI build out. Do you see any perils to any company back then that could compare to maybe an Oracle now? Like, should we all be worried about Oracle based on like their credit and their rating? Because I know you said like jump bonds, anything below A. So like they're not necessarily terrible. Like triple B is not necessarily terrible. It's a jump bond is going to pay you a little bit higher rate. But do you see like any companies that parallel that to from back then to now?
Yeah, I've been away from it, Marcus, but we used to focus on triple C. They were one of the significantly large tier of debt in the high yield space. Triple C was like the lowest rung. You go down to triple C minus, and after triple C, it was default. So if we start seeing more and more companies with those ratings coming to market and issuing, it was a sort of a sign for us that look at people are loaning these companies money, purchasing their debt, and their financial metrics, their leverage profiles, and their ability to service that debt are very, very weak. But you'd hear, well, people have money to put to work, so we have to buy something. We're afraid just to sit on the sidelines. I get nervous about the rise in triple C, and the high yield market was always a good indication because as spreads blew out, they were termed like the smart money. They were able to understand when the economy was all of a sudden going to turn south, like a precursor to potential economic deterioration. So we always kept our eye on that. Today, again, we've come through an earnings season. The earnings were pretty solid for the big names. We don't see, high yield interest rates or debt rates are in the mid six. So not something to get alarmed about. When you see spreads blow out, spreads, I mean the rate over treasuries, because treasuries are the primary, they're considered non-defaultable, and all other rates typically key off of that in the corporate space. It's treasuries plus. So spread over treasuries. That's the amount that you need to be compensated for the risk you're taking on and lending money to that entity or company. So the higher the risk, the higher that spread and the higher the yield or interest rate needs to be. So keeping your eyes on that. And they haven't blown out. We haven't seen any dislocations yet. At least I'm not aware of any. But again, I'm not in there every day like I used to be. So is it a problem when you see a lot of these big players like Oracle's issued a ton of debt? Now, they have triple B ratings. So, they're probably in the middle of investment grade. So not overly concerning, but we'll watch those. The more that gets issued, potentially that could trigger a problem, more debt that they take on. So I haven't seen it. I know Microsoft, Meta, Amazon, they're spending huge, right? Hundreds of billions of dollars in CapEx. Some of them are issuing debt. But these are companies that just have gargantuan balance sheets, billions in cash, and they're just not an issue. They're AAA rated at Microsoft level, and the other one's a AA. So I think the Mag 7 are very, very strong, maybe with the exception of Tesla. Tesla's, I think, triple B, but I don't have an issue with regards to them. But it's important to watch other issuers, watch those high yield spread levels, and see where they go. But earnings have been good. The guidance given by many of the companies, we're not finished earnings season yet, of course, but I think what we've heard so far is pretty constructive, pretty positive. So I don't, there's nothing I can foresee. But Marcus, you know as well as I do, that doesn't mean we can't have like some event that comes out of the woodwork and that no one was focused on.
One.
Yeah, so I just I don't know, you can't discount that. But you mentioned another thing, credit default swap levels. Credit default swaps were developed to sort of offset the risk that the banks were taking when they were loaning money to companies. And you and I spoke offline about this with Enron. When Enron was coming along and they were issuing all this debt and they were the darling company. Everyone was investing in them and buying their debt. The banks who were loaning them money were buying credit default swaps. No one knew to ask the question, why are they buying? Who's buying? It just came to light after the fact. But that's like a perfect example. But keep your eyes on credit default swap levels because they're also a great indicator. Each country has a sovereign credit default swap level, and developing countries or emerging companies will have much higher credit default swap levels. The U.S. is pretty good, but there are countries that are tighter. There's still AAA countries like Switzerland, many of the Nordic countries. Keep your eye on CDS levels, high yield levels. I think those are good sort of read-throughs to think about how sophisticated investors are thinking about risk. But again, to your point, something comes out of the woodwork. You never know. It's hard to plan for those, but absolutely possible.
No, that's a great explanation of how someone can look at the ratings of the AAA or triple C and see, like you said, you see where the institutions are moving. It shows the debt that's coming out and how the markets are going to respond as well, and just where your money where other money's moving. That doesn't exactly mean your money should move where the money moves. Some people are contrarian investors, but it shows you where the money's actually moving. That's just a really good breakdown into that. I guess I've been stealing your brain for almost an hour now. I guess one thing that I do want our listeners to get from this conversation, like you worked at the ratings agency and they might not exactly understand what that means. And like, can you just like break down, like, I know you gave a brief breakdown of it earlier, like what the rating agency is, who they are, but like when you say triple C, triple B, obviously the lower the grade, the higher the interest a company's going to pay you because they're taking on more of a risk. But like what makes one company a triple, what makes Oracle triple B and Microsoft triple A?
Yeah. So when I worked analyzing debt, Marcus, for both investment grade and high yield, a big part of our time was spent focused on what the ratings agencies were doing, how they assessed the companies that they rated. Because if you brought a bond deal, you wanted it rated. If you didn't have it rated, unrated bonds, probably there are many people who cannot buy unrated bonds, will stay away from them. There won't be the demand, and you're going to pay through the nose. Now, so the ratings agencies, they're officially known as the nationally recognized statistical rating organization, NRSRO. They're registered with the U.S. Securities and Exchange, and they evaluate the credit worthiness of issuers and financial instruments. So in the debt space, you have all sorts of different types of financial instruments: senior secured debt, unsecured debt, subordinated debt. It goes on and on. Basically, the ratings agencies are assessing the risk of the debt. They're assessing the risk of the companies issuing the debt and of the specific instruments. So Moody's, S&P, and Fitch, they will go in to those companies and ask to see if it's their first time doing it. They want all the financial information going back to the beginning, and then going forward, they want to see projections, however far out the company does that. A lot of the information that they had access to was they were privileged to, wouldn't be provided or disclosed to, say, ordinary investors. So they were charged with going through those numbers, looking at management, number of factors involved in analyzing and rating the debt. And, they have their proprietary or specific methods for how they did that. There's a lot of overlap, but just like we would look at an individual or a rating aid, TransUnion or Experian, Equifax would look at an individual ability to service the debt, sources, income, projections, management's ability, covenant packages, protections around specific debt instruments, all of these things. And they would go through and provide a rating. And for those looking to issue debt, the stronger the company, the higher the rating, the lower the cost of that debt. And so it was real important. It speaks to quality. It would speak to demand. There are many funds that can only invest in investment grade rated bonds, so that's really important to them. So if I'm a company and I'm on the cusp, I want to get the lowest triple B because it's going to be cheaper for me and I'm going to have stronger demand. So it's important from an issuer's perspective. And so also by the same reasoning, if I'm an investment grade company and I'm in danger, my numbers are bad and I'm in danger of losing my investment grade ratings and possibly going down to high yield or junk status, that's called a fallen angel. That could be detrimental because now my bonds fall and those people that thought they were invested in investment grade have to sell. They're forced sellers. So the bonds take a hit. And it has a lot of repercussions because if I have to refinance debt or come to the market with another debt issue, now I was once investment grade, now I'm high yield. Now I have to issue as high yield. I have more stringent covenants or requirements for me to issue. I got a higher interest cost. It takes more of the profitability, impacts on profitability. So all these things are real important. But basically the ratings agencies, they're just like Equifax, Experian, TransUnion. They're assessing the credit risk of the organizations, of the corporations, and there are municipalities, everything. They're involved across the board, and also the specific debt instruments, commercial paper, unsecured debt, senior unsecured, subordinated, at the operating company, at the holding company. It gets very complex, and it's very it's significant, right? Because we talked about the size of the debt market versus the equity market. It's far-reaching and really important. And the ratings agencies have to do a good job because if they don't, it's their reputation at stake, and this is how they earn their money. They're paid to provide the ratings on the bonds and entities, and if they do a lousy job, it'll come back to bite them. We go back to 2008, 2009 when the economy fell off a cliff. A lot of people blame the ratings agencies because they ran behind. They were less focused on the pricing of the bonds versus the analysis of the company's financials, meaning the one part of the puzzle that they didn't factor in was the market price of bonds. Just like when people look at equity prices, if you know nothing else, but you see equity prices dropping, it should raise questions. Wait a minute, something's going on. What am I missing? We got to take another look at this. And they were generally backward looking. And yeah, they were forward looking to the extent that, okay, we'll look at projections and forecasts, but it's not the same when there are so many smart people out there and the market as a whole functions like that, and they're telling you something through price action that something is wrong or potentially problematic. It has to be addressed. It may not show up in your numbers, but there's something there that needs to be explored further.
Yeah, the bond market really does like run stuff. I don't think people realize like how powerful the bond market is. That's a great breakdown of the rating agencies as well and how
Yeah,
they do it. Um, I just got a couple more questions for James. So, like, just given
sure.
this macro outlook right now, and this is for Main Street. We're bringing helping Main Street meet Wall Street. How would you? And I know you're not in it every day. How would you maybe tell the average investor maybe to position themselves like hard assets versus maybe international assets, not equities or anything like specific names or like inflation protected securities? You think should be like more of a hedge, or you think they should be buying the dip and like concentrating in all more on equities right now?
It's all individual and specific, right, Marcus? It's
Right.
so hard because everyone has different needs. Everyone's a different age. They approach retirement differently. I would think to young people who are just starting out, I think that they want to be extremely aggressive in their investing, and we know about the time value of money and compounding. And so they should just be in the market. And, whether that's, again, I'm not going to tell anybody what to do through ETFs, through funds. I think, do some homework, learn. But I think you should be more aggressive the younger you are. I think it doesn't hurt to be diversified. But again, at that young age, you're probably going to need fixed income really shouldn't be a focus. Again, international, there are so many opportunities. There are economies that are growing incredibly fast, like China, India. I think having the ability to invest in those countries makes a lot of sense. I would encourage younger people to be more aggressive. But again, that doesn't mean you don't do your homework and you don't learn as much as possible and try to understand what you're investing in. And most importantly, always keeping in the back of your mind, even something that's could be potentially strong, there's always a risk of loss. And if you need money soon or in a few years, or you're trying to buy a house, you have to factor that in and say, hey, look, this is capital I cannot risk. I have to preserve it. There's a big difference between putting something at risk and preserving and trying to grow it. So I would just say keep that in mind. But again, the more education, the more an investor educates him or herself, I think the better off they'll be, because no one has a crystal ball. Some people make some great calls, but you just never know. It's individual and it's personal. Someone older is going to have needs for more income or fixed income. They'll have to address bonds and corporate debt. So I think that's something that ought to be looked at. And again, ETFs, and there are multiple ways to do that. Very low cost. Vanguard is great at that. And maybe someone older feels less comfortable with investing internationally, and that's fine. Higher quality. You want to take minimal or no risk at all. So all those things have to be factored in, and some people may not be comfortable doing it themselves. They should contact and have conversations with people like yourselves and other money managers who can maybe, ask them questions and find out what their needs are, because everyone has different needs, goals, and safety or risk parameters. And so, yeah, I would just leave it at that. But the most important thing, I think, Marcus, is understanding risk and trying to mitigate it, because sometimes it's hidden, it lurks below the surface, and it can hurt you if you're over allocated to a specific area, concentrated. So I think in anything you do, you have to understand the risks and the downside. And if you can get comfortable with that, it makes it a little bit easier. But again, even that is no guarantee against seeing your investments decline.
Right. That's a great point that everyone's a lot of great points, but that everyone's different depending on your time horizon. And that this is not personalized financial advice that we're giving people. If you need some personalized financial advice, you should go sit down with a professional. But this is definitely some good information to help you make informed decisions, which is one of the goals of this conversation. One thing I may have missed you or didn't hear you say was gold. That's interesting that you didn't say think about metals in there for the
Yeah,
diversification.
it's funny, Marcus. I guess because I had a hard time with gold.
Valuing
It's
it.
not like a stock or bond. A bond has an interest component. A stock has a dividend or the ability to appreciate, and gold does too. But like in and of itself, I know there's a jewelry component people use, but I don't. For me, it's harder to understand. It's like crypto, and perhaps it's my age. I need to see how something has an intrinsic value. I know a stock represents an ownership, and that ownership can grow and increase through the value of reinvestment or through the payment of a dividend bond. I'm going to hopefully get, depending upon the quality of the issue, get my money back plus an interest component. And I just, again, there are people who are much smarter than me and understand those things better. So I just have to try to stick to what I know. And again, what we talked about, what I feel comfortable with, how much risk am I willing to take? If I don't think I can understand something, then I'm never going to be able to sleep comfortably at night if I know, Jesus, I don't know what I'm doing here. And people shouldn't feel that way. We talk about like this fear of missing out, FOMO. The market's there. It's always going to be there. There are new companies coming along all the time. I think you should be comfortable, start small, learn. As you get more seasoned, more educated, you increase your rate of investment. Learn about mortgages, your own investment, budgeting your paycheck. How much am I going to spend? I think those things are real important. I think those will help most people, right? That's what I tried to do when I started out. Okay, I have a checking account. This is my net pay. All right, I know I've got to pay this, and that's like the foundation. Because I think if you can do that, it goes a long way. People
Yeah.
shouldn't feel bad about that because we all start out the same way. We're all capable, and with the tools out there now, I think it makes things easier.
Yeah, there's so much information out there right now. Like there's just enough information to be dangerous for some people, unfortunately. But those are definitely really salient points that you made, and people really should know what they're investing in. Just because someone is telling you to invest in gold, if you don't understand why gold makes sense, or you don't understand why Bitcoin makes sense, or you don't understand why blockchain makes sense. And by the way, these are all things that we're going to have people coming on and talking about pros and cons. We're going to have a guy come on talking about the pros of Bitcoin, the cons of Bitcoin. We're going to talk about blockchain. So it's just going to be a wide range of series here. But yeah, if you don't understand what you're investing in, you probably shouldn't be investing in it. That's one of the big things. And yeah, man,
And
like I said, I
Marcus, and
really
that no
go ahead.
way, and sorry for interrupting, in no way is that like a put down or yeah, casting any negative aspersions on those asset classes.
Oh no.
It's just a personal preference of mine, and yeah, I just and I think the blockchain that would be a great topic. I've spent some time, but I think that would be a great topic for you to address. I think that would be fantastic because I think it's definitely here to stay, and we'll have that's what will hopefully eventually provide value for cryptocurrencies, et cetera. But I think that would be a great topic for you to explore.
Yeah. Oh, yeah. Thank you. Yeah, and it'll be good. And yeah, and there will be people you express. This is a space for you to express your whatever you want to say, James. I'm fine with that. There will be people, like I said, there'll be an episode with a guy who's a real big crypto bull, and there's a guy on another episode who's a real big crypto bear. So like doesn't believe there's any value in it. So yeah, we're going to give these people, we're going to give people information, mainstream information, and then we want them to make informed decisions, man. With that being said, I know we're over an hour, man. This is so much. I could talk to you all day, Jim.
No, no worries, no
But
worries at all.
I want to, I want to hit you with, I have a question for you, and then I just want you to say whenever you let people know where they can find you. So we've talked about a lot of stuff right now, and if someone has probably sat here from the beginning to the end of this episode, they might be a little bit afraid, like, oh my goodness, we got 3 or 4 times the debt than what I thought we initially had when you count Social Security and all these other funds that we have to fund. Worst case scenario, best case scenario, like, is there a way out of this, I'm air quoting, massive crisis that we might be in right now? How would you suggest that, Jim?
Yeah, I just think for most people to understand it, that it could be problematic. I'm not saying that it is now. It is a concern. The U.S., again, we've never defaulted on debt. We have a lot of smart people in this country, and it would be good if both parties could sit down and address it. I think to me, we do have a spending problem, and I think that's a big driver of it. And I think that has to be addressed. And I definitely think there's a way. There are too many smart people in this country for it not to be addressed. But it is a concern. I think more that people think about it and understand it and apply it maybe at a personal level, I think that's a good thing. And so, yeah, I'm concerned. These are big numbers, but we got a lot of people that are starting to look at this and address it. And hopefully, over the next 5 to 10 years, there's some sort of a plan or drawn up as a way to address it. But I think looking at spending as this administration has done is important, and shrinking the size of that deficit. So going forward, it starts to maybe move the other way would be helpful. Yeah, just so the people are aware of it and why interest rates matter, Fed funds rate, and why it's really important to understand how it affects everything within our economy.
Yes, very, very good. That stuff breaks it translates right down to Main Street, just hopefully folks got something out of this conversation we just had. I know I took a lot from it. Like I said, when we were on that meeting the other day and you mentioned the total debt that just jumped, that really just hit me in the head. I don't know. I guess I never really just thought about the whole encompassing debt. And then could you imagine if the US had a sovereign default, if we actually bounced a check to someone that we owed money to? That's like those are the kind of questions that start running in my
Yeah,
head. So I don't know if other people in Main Street are having those questions, when we get there. So it's just really good to have you on. I know you're hiding or you're laying low. I don't know if you want anyone to find you, but if they ever did, are you on LinkedIn or anywhere? Where could they connect with you, James? 'Cause you
yeah,
have
I'm
so
on
much
LinkedIn.
information.
I am on LinkedIn, and that would be helpful. Again, I've been out of the industry for about 7 years now, so my knowledge is not up to date, and but always happy to talk to anyone, anything I can do. But there's so many good websites out there as well, and this information is accessible, the Treasury websites, etc. But yeah, Marcus, more than happy to help on LinkedIn, and yeah, that will be fine.
Yeah, thank you, James. Yeah, and for anyone looking, this podcast, Main Street meets Wall Street. We're here just to take Main Street part, add some Wall Street smarts, combine them together, and just see how we can help Main Street meet Wall Street. I really appreciate James coming on. If anyone found any value from this, subscribe, like, hit, do all that normal stuff. Thanks for coming on, James.
Thank you, Marcus. Really appreciate it. You take care.
You too. Thank you.
Bye.
Thank you for joining us for part 2 of our deep dive into the national debt on the Main Street Meets Wall Street podcast. We hope you found our conversation with James Callahan both informative and thought-provoking. If you enjoyed this episode, be sure to check out our YouTube channel with Marcus Sturtevant Sr. for more engaging content and discussions. Don't forget to subscribe to stay up to date with our latest videos. Looking ahead, we're excited to announce that our upcoming episodes will feature insightful conversations with industry experts like Adam Parker. His part 2 is coming up. Next week, we'll be diving deep into the world of crypto with bears and bulls to explore the financial impacts and potential and hits to Main Street. Thank you again for listening. We look forward to having you with us in our future episodes. Remember, Main Street Heart, Wall Street Smarts. Stay curious and informed.